713,502.
That is a very specific number. And depending on what we're talking about, that's either a fun statistic or maybe a terrifyingly large hoard.
It is a hoard. That's the number of Bitcoin Strategy Inc. held as of February 1st, 2026. Just let that sink in for a second.
Over 700,000 Bitcoin.
Under one corporate roof.
To put that in perspective, there will only ever be 21 million Bitcoin. Strategy Inc. They now control nearly 3.5% of the entire theoretical supply.
Wow.
I mean, it's a level of accumulation we haven't really seen since, like, the early oil barons or the old railroad monopolies.
Exactly. And the reason we're doing a deep dive on this today is that Strategy Inc. just dropped their fourth quarter 2025 financial results. That was just yesterday, February 5th.
Right.
And if you're just, scrolling through financial headlines, you probably saw some pretty ugly words. Operating loss, billions in the red, things like that.
Oh, for sure. If you just glanced at a terminal, you'd think the company was burning to the ground. They posted a $17 billion operating loss.
$17 billion.
In any other industry, that's usually the signal to pack up your desk and head for the door.
But we have the actual 8K filing and the press release right here in front of us. And when you actually open the document, the story isn't about a company losing money. It's about a company that is fundamentally rewriting how corporate finance works.
It really is. It's a classic case of the accounting rules not keeping up with the economic reality. The headlines scream loss, but the mechanics behind it, the digital credit instruments, the sheer velocity of their capital raising, it all tells a story about a completely new kind of financial ecosystem.
So that's our mission for this deep dive. We're not just looking at earnings. We are going to unpack how a company can operate as a Bitcoin treasury.
And how they managed to raise over $25 billion in a single year, more than almost anyone else on Wall Street.
And we're going to explain why losing $17 billion might actually be a calculated part of their grand plan.
It sounds completely backwards, I know. But once you get the engineering behind it, you realize they aren't playing the same game as everyone else.
Okay, let's start with what they call the Bitcoin Fortress. We mentioned the total count, 713,502 BTC. The total cost basis for all that is somewhere around $54 billion.
Which averages out to about $76,052 per Bitcoin?
Right, and they are not slowing down. In January 2026 alone, so just last month, they snapped up another 41,002 Bitcoins.
That is just a staggering amount of buying pressure in a 30-day window.
Yeah.
It's more Bitcoin than most public mining companies produce in a decade.
It shows real conviction. But what's fascinating here isn't just the shopping spree, it's how they measure their own success. If you look at the report, they don't lead with net income or EBITDA or any of that.
No, they highlight a metric they call BTC yield.
Yes, I saw that. It came in at 22.8% for the full year of 2025. And I want to pause here because, yield usually means I get a check, I get a dividend. Bitcoin doesn't pay a dividend. So what on earth is BTC yield?
This is a really crucial distinction. Normally, yield is income. But here, Strategy Inc. is sort of redefining it. They're measuring the accretive growth of their Bitcoin holdings per share.
Okay, so define accretive for us in this context, because I think a lot of people, they hear dilution when a company sells stock and they just assume it's bad.
Sure. So usually when a company issues new stock, they're diluting you. If you owned 1% of the company and they issue more shares, you now own, less than 1%.
Right. My slice of the pie gets smaller.
Exactly. Strategy Inc. is issuing massive amounts of shares, but they're using that money to buy Bitcoin so aggressively that the amount of Bitcoin backing your specific share is actually going up.
So even though my percentage ownership of the company might be getting diluted, my actual exposure to the Bitcoin is increasing.
Precisely. That 22.8% BTC yield means that for every share you held on January 1st, by the end of the year, that same share represented nearly 23% more Bitcoin. They aren't measuring success in dollars. They're measuring it in Bitcoin per share.
That's a total paradigm shift. Most companies try to maximize earnings per share in dollars. These guys are maximizing Bitcoin per share.
And that shift in thinking drives everything else they do.
Yeah.
To get that yield to buy Bitcoin faster than the dilution hurts, they need capital. Huge amounts of capital.
Which leads us to the second and honestly more complex part of this report, the capital markets machine.
Right?
This part just blew my mind. In 2025, Strategy Inc. raised $25.3 billion.
Just a colossal figure.
But here's the kicker from the report. This made them the largest U.S. equity issuer in 2025. They accounted for roughly 8% of the total U.S. equity issuance.
Think about that for a second. You have all the tech giants, the big banks, all the IPOs, and this one company was responsible for nearly 1/10 of all equity raised in the United States.
It's insane. It's like they're sucking all the oxygen out of the room, and they're
Yeah.
doing it through this alphabet soup of ticker symbols on the NASDAQ. I saw STRF, STRC, STRK, STRD, and of course the original MSTR. Why so many?
They're segmenting the market. It's like they've built a whole suite of financial products for different kinds of investors. But the one that really stands out in this report is STRC, or Stretch.
Right, Stretch. This is their, quote, flagship digital credit instrument. It says here it's scaled to $3.4 billion in size. And the dividend rate it's eye-watering, 11.25%.
Which is a very attractive yield in almost any market. It's competitive with high-yield junk bonds, but with a totally different risk profile.
But how does it work? Because the report talks about a dividend adjustment framework that acts almost like a thermostat. I tried reading the methodology, and honestly, I got a bit lost in the basis points and VWAP talk. Can you just simplify what it's actually doing?
It's actually quite brilliant, if a bit complex. So STRC is a preferred stock. It's designed to trade at a stable price, right around $100 a share. Okay.
But the problem is, it's backed by a company holding Bitcoin. Bitcoin is super volatile. So how do you keep the stock price flat when the underlying asset is bouncing all over the place?
You bribe the investors.
Essentially, yes. You adjust the payout.
Mm-hmm.
The framework is rules-based. They look at the volume-weighted average price, or VWAP, which is just the average price the stock traded at that day. If the price of STRC drops below $95, the thermostat kicks in. The company then recommends raising the dividend rate.
I see. So if the price drops, the yield goes up. That 11% becomes 12 or 13%. That brings in buyers who want the higher yield, and their buying pushes the price back up towards 100.
Exactly. It's a self-correcting loop. And on the flip side, if the price goes above $101, if it gets too expensive, they recommend lowering the dividend.
Because they don't need to pay people as much to hold it if it's trading that high.
Correct. They've engineered a way to take the wild swings of crypto, filter it through this thermostat, and spit out a steady 11% yield for people who just want cash flow.
It's financial engineering at a very high level, and it lets them tap into a whole different pool of investors.
Totally. They aren't just asking crypto bros for money anymore. They're tapping into the fixed income market, which is trillions of dollars larger than the crypto market.
That makes perfect sense. But I have to play devil's advocate here. It sounds great on paper, but we have to talk about the elephant in the room. That scary number.
The operating loss.
We have to. The report shows a Q4 operating loss of $17.4 billion. Billion. With a B. If I saw that number for a normal company, I'd assume they were filing for bankruptcy. How do you lose $17 billion and call it a landmark year?
Okay, so this is where you have to put on your accountant hat and understand fair value accounting. It's a technical term, but it's everything here.
Yeah.
That $17.4 billion isn't cash they lost. They didn't just set a pile of money on fire.
Right.
It's an unrealized loss on their digital assets.
Okay, unpack unrealized for us. Because, a loss is a loss to me.
Not in accounting. So imagine you own a house. You bought it for $500,000, the market dips, and Zillow says it's now worth $400,000. You haven't sold the house. You haven't actually lost a penny of cash. But on paper, your net worth just went down.
Okay, I follow that.
It's the same thing. Strategy Inc. holds all this Bitcoin. When the price of Bitcoin dips, even a little, the paper value of that massive pile drops by billions. Accounting rules require them to report that drop as a loss for that quarter.
So just because they took a snapshot on December 31st and the price happened to be down at that one moment, they have to report a $17 billion loss.
That's it. It's just an accounting mark. It's not cash leaving the building. In fact, if you look at their actual cash situation, it's a completely different story.
Oh, yeah. I'm looking at the line for cash and cash equivalents. It skyrocketed. They had $2.3 billion in cash at the end of the year. The year before, it was just $38 million.
That's the paradox, right? Yeah. They went from $38 million to $2.3 billion in cash while reporting a $17 billion loss. The accounting makes them look like they're bleeding out, but they are absolutely flush with cash.
And a big chunk of that cash is what they're calling the USD reserve. Let's talk about that. They set aside $2.25 billion. Why?
Yeah.
Why sit on that much cash if your whole mission is to be a Bitcoin treasury? Shouldn't they just buy more Bitcoin?
Well, remember that STRC dividend we just talked about, that 11% yield?
Yeah.
You have to actually pay that.
Yeah.
And you have to pay it in dollars.
Right. Investors want cash.
Exactly. The CFO, Andrew Kang, called this reserve a digital fortress. Its purpose is to provide coverage for those dividend and interest payments for, I think the report estimates about 2.5 years.
So even if the crypto market crashes and we go into a crypto winter for 2 years, they have the cash just sitting there to keep paying those 11% dividends on STRC.
It removes the existential risk. An investor in STRC doesn't have to worry if Bitcoin crashes tomorrow. The cash is already in the bank to pay them through 2028.
Okay, there's another detail in this report that feels like a game changer for the individual investor listening. It's buried in the tax section, the ROC insight.
Ah, yes. Return of capital.
Yeah.
This is critical if you want to understand why investors are flocking to this.
The report says that 100% of the distributions paid in 2025 were treated as a non-taxable return of capital, and they expect that to continue for the foreseeable future, which they define as 10 years or more.
This is massive.
Break it down for me. What does that mean for my tax bill?
Normally, if you get a dividend from a company, the IRS treats that as income. You pay tax on it that year.
Yeah.
But with a return of capital, the IRS sees it as the company just giving you back some of the money you originally invested.
So it's not income.
Not immediately, no. Instead of paying tax now, it just lowers your cost basis. So let's say you bought a share of STRC for $100. They pay you $10. You don't pay tax on that $10. Instead, the IRS just thinks you bought the share for $90 now.
Okay, so I've deferred the tax.
Right. You don't pay any tax until you actually sell the stock, maybe years down the road. And when you do sell, you pay capital gains tax, which is usually lower than income tax.
That is powerful. So you're getting an 11.25% yield, and you aren't paying taxes on it year to year.
And in the world of compounding, deferring taxes is basically the same as getting a higher return. The fact that they explicitly said they expect this to continue for 10 years or more is a huge signal to the market.
And how are they allowed to do this? It sounds like a cheat code.
It comes back to that operating loss we talked about. Because they have these massive accounting losses, they don't have earnings and profits in the traditional tax sense. So any distribution they make can't come from profits. It has to be classified as a return of capital.
It all connects. The accounting loss that looks so scary actually enables the tax benefit for investors.
Precisely. The pieces of the puzzle just fit together perfectly.
Now, before we get too carried away, we should probably mention there's still an actual software company under all of this.
They did. And they still do. And it's doing fine.
Yeah, revenue was $123 million, up about 2%. Subscription services jumped 62%.
It's important context. The original business is still functional and growing. But let's be honest, $123 million in revenue is kind of a drop in the bucket compared to $60 billion in assets.
It's like a lemonade stand attached to a bank vault.
A very nice, profitable lemonade stand. But yes, its real value now is that it provides a base of operations. It lets them be an operating company on the NASDAQ, not an ETF.
So let's zoom out. We've got a company with 700,000 Bitcoins. They're raising $25 billion a year. They've created this thermostat dividend that yields over 11% tax deferred. And they have a cash reserve to survive a multi-year crypto winter.
When you put it all together like that, you realize this isn't just a company buying Bitcoin anymore. They've evolved.
No, it feels like something else entirely. Michael Saylor, the chairman, had a quote in the report that stuck with me. He said they're excited about an ecosystem emerging around STRC.
That word ecosystem is key. They aren't just issuing a stock. They're creating financial building blocks.
And the CFO called their setup a digital fortress.
It is a fortress. By having that massive pile of Bitcoin and the cash reserve, they become the dominant issuer of Bitcoin-backed credit, to quote Saylor again.
It sounds like they're trying to become the central bank of the Bitcoin economy.
That's a very provocative way to put it, but it's not that far off. If you're the largest holder of the asset and the largest issuer of securities backed by it, you effectively set the rates. You control the gravity of that market.
It's just fascinating. We started this deep dive looking at a confusing press release with a massive loss, and we've ended up describing a financial machine that is rewriting how capital markets interact with crypto.
And doing it with a level of scale we just haven't seen before. They are bridging the gap between the chaos of crypto and the order of Wall Street.
So here's the final thought I want to leave you with today. Strategy Inc. has raised $25 billion to buy Bitcoin. They have a dividend system that functions like a corporate bond. They have a 10-year horizon on their tax strategy.
They're playing a very, very long game.
Exactly. If they are already the largest equity issuer in the U.S., have they effectively become too big to ignore? And if their model works, what happens when other companies decide they need to copy them? Are we looking at the blueprint for the corporation in the future?
That's the multi-billion-dollar question, isn't it? And frankly, I don't think Wall Street has an answer for it yet.
Something to think about. That's it for our deep dive into the Strategy Inc. Q4 2025 report. Thanks for listening, and we'll catch you on the next one.
Stay curious.